Hello, investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a one-year daily candle chart of the Qs. This is basically the ETF that represents the NASDAQ market. And as I do each and every week, I leave my lines on the chart so our viewers can see just how accurate the forecasts are, and really stressing the importance of using technical analysis, particularly candle charts, as our tool for forecasting the markets. And if I zoom in here, you'll see that this diagonal red line was what I drew last week. Now remember, when I did this last Friday, these candles were not here yet. So this here, this green candle, was the close from last Friday, and I said that we had a hammer pattern there, which was very bullish. So I drew this line as my forecast, and I said that we would most likely rally up to test resistance right here at the 182.93 level, and I extended this line out to again emphasize that resistance level. Now, what does that mean for next week? Yeah, it's great to be able to look back now and see how accurate the forecast was, but what do we have in store for next week? Well, if you look down at the bottom of the chart, you'll see this blue line. This is the stochastics oscillator, and I've been talking a lot about this lately, particularly with our subscribers, and this is called the K line on the stochastics, and that measures the momentum or the speed at which the prices are moving higher. And you can see that the momentum is still moving up. The red line is a moving average of the K, and that's called the D line. I'm not going to get into that right now, but the fact that this line is moving up tells us that the momentum is still moving to the higher level. So let me draw my lines for next week. This is what I think we could see. I believe that we will see a slight breakout of that resistance. So I'm going to draw this just like that. I think we're going to move higher. And then I believe we're going to pull back to drop right back below the line. Now, normally that would be a role reversal line right there. But the reason I think we could pull back below the line is because if you notice, we're drifting quite far away from this 20-period moving average. And we call this the rubber band effect. And if the volume down here was a little bit higher, today I'm recording this on the 24th of August. If that volume was higher, I would have not even suggested that we would see a pullback later in the week. But I'm starting to see a little bit of weakness on the buy side because of that drop in volume. Hence the reason why I think we'll pull back later in the week next week. So that was 100% accurate with my forecast from last week on the Qs. And the next one is the spiders. This was pretty amazing because if you look at this one, again, I leave my lines on the chart so you can see. What I said is that early in the week, particularly Monday and Tuesday, would move up. And then I said we would pull back with the end of this line right there being my target. So what happened? Monday and Tuesday, we went up just like I said we would. And like clockwork, we turned on a dime and started moving lower. And you can see here on Thursday, the low was right at that target level. And then we bounced. So like the Qs, the S&P is showing momentum to the upside. Again, you can see that the blue line is starting to move higher. However, there is an increase in volume right there, which tells us that the buyers are a little bit more motivated on the spiders than they were on the Qs. So what I'm going to do is I'm going to have to really condense this a little bit. I think that we are going to rally up next week on the spiders, and I don't think we're going to see the pullback that we saw in the tech sector. I think S&P is going to move higher, and the end of that line is now my target. So keep an eye on that. It doesn't mean that you should, sell the house, sell the cat, sell the kids, and get long stocks. I'm not that motivated to buy. However, I do think that there is some opportunity in the short term to the upside. Just make sure that you're protecting yourself with some type of risk management plan, whether it be with stops or options perhaps. Now, at the end of next week, this divergence from the moving average will be quite wide. So I think while there could be a possibility we'll pull back, I think that will happen early next week because, again, the volume is increasing down here, and that tells us that the buyers are motivated. And that's a pretty significant green candle right there. So I think we're going to go higher on the S&P. Now let's look at the VIX, because the VIX is a contrarian indicator to the S&P. In fact, they're inversely related. And what I said last week on the VIX is that we would move lower. You see this? And on Monday, we had a lower low than we had on Friday. Tuesday was a lower low. Wednesday was a lower low. Thursday was a lower low. But Friday was a higher low. This is a red candle, but I still think the VIX is going to drop here because there's still an open gap down here that needs to be filled. And I said last week that we could very well see that gap filled because, according to my research, 100% of the gaps that are left on the VIX eventually fill. So this is going to be a short-term pullback to fill that gap, and then we'll have to see whether or not we see the VIX rally. If we see the VIX start to move up, remember they're inversely related to the S&P, then you could start to see the pullback in the S&P as well. Now let's get to the two markets that were, I would have to say, 50% accurate. Weren't completely accurate, but they were accurate enough to make some money. And you can see that I said that we would most likely move up and then start to pull back to fill this gap. What happened is we moved up Monday and Tuesday exactly like I said it would, and then on Wednesday we started a pullback. Thursday we pulled back, so we only pulled back about 50% of this target right here, and then we started to bounce. Eventually, I think that gap will fill down here, but what I'm going to do for next week is erase this line and draw very similar lines to what we had on the S&P. I think that we could move up a little bit higher. Why? Because the volume is still strong. I'll get to that in a minute. And then towards the end of the week, again, because we're having that stretch from the moving average, I think we could start to pull back. So look at the volume. You see the increase in volume? That's telling us that the buyers are motivated. And this K line, the blue line down here, has gone from a downward direction to now it's starting to tick back up. Keep in mind that this line right here, let me scrunch this down just a little bit. These two parallel lines, the bottom line is 20%, the upper line is 80. Anything over 80 is considered overbought, but in a strong market, it could stay overbought for a little while. So we'll have to keep an eye on this stochastics because that's a momentum indicator as well, and we'll see whether or not we start to shift later in the week. But again, to reiterate, I think we'll go into rally for most of next week and then possibly pull back later in the week. We'll have to see how that goes. Now, the Russell 2000, which is the more broad-based index out of all of them, it went up just like I said we would, but we broke through resistance here. We did not pull back from resistance. There are no gaps on the Russell 2000. So what that means is there's not going to be any kind of a draw to the downside with regard to gap fills. But let me clean this up. I'm going to erase all the lines. You can see, again, we went up like I said we would, but we didn't pull back. Interesting thing, though, we had a red candle yesterday on Thursday that was almost a bearish engulfing pattern. What I think we're going to see in the Russell 2000 is going to be slightly different than what I said in the other markets. And in fact, I think what we'll do is we'll rally Monday and Tuesday, but I think Wednesday, Thursday, and Friday we're going to drop just like that. The Russell 2000 does not always go in line with the rest of the indices. However, it is the more broad-based index, so we do watch that because it carries more weight than the other markets. So that's our forecast for next week. I hope you're enjoying the videos that we have available for you on the Market Guys website. Just go there. The video library is free to the public. You can learn more about what we do here and learn the lingo and learn the strategies so you can at least learn how to manage risk in a better way than you might have in the past. And I've always believed that the risk management is the most important part of trading or investing, and I hope you take that seriously. So have a great weekend, and we'll talk to you soon. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.